The US Department of Energy crude oil inventories have highlighted a continued downtrend in oil production, marred by a slowdown in global growth and concerns over supply disruptions. Talking to me today is Walter de Wet, Head of Commodity Research at Standard Bank. Thanks for joining me, Walter. US commercial crude oil inventories decreased by 3.7 million barrels from the previous week. Is this indicative of an increase in consumption or a slowdown in supply? What's the sentiment surrounding this data?
We certainly interpret the drawdown in inventories, and we've seen, of course, inventories in crude and products down substantially this week, mainly on the back of supply concerns in the U.S. because of the hurricane season, some hurricanes in the Gulf of Mexico, and also some supply concerns over potential Brent production going forward the next couple of weeks. So, we don't think it's necessarily demand-driven, but more supply concern.
The US Energy Information Administration have upgraded its expectations regarding the pace of global oil consumption this year and in 2013. They've warned, however, that there continue to be downside risks to demand. What are these risks?
Yes, certainly there is downside risk, and indeed they've increased their demand estimates. But, given that the U.S. growth seems to be slowing, and we're also looking at, for example, Chinese growth, which also seems to be slowing. There is definitely downside risk from a demand perspective. Of course, crude oil and all crude products are heavily dependent on the transport sector. And as soon as we see growth slow or even a contraction in industries like manufacturing, typically transport needs also decline pretty fast, which does put downward pressure on product demand and ultimately also on crude demand and, of course, prices too.
These concerns are compounded by the slowdown you've previously mentioned. Total products supplied over the last 4-week period have averaged 18.9 million barrels per day, down by 1.9% compared to the similar period last year. This includes a reduced output in products such as jet fuel and motor gasoline, which is down 4.2% from the same period last year. How does this impact the consumer?
Well, ultimately, if crude oil prices, inventories go down, and of course product inventories go down too, if it's at low enough levels, it should start putting upward prices on prices at the pump, and in other words, gasoline and gas prices, and people will just end up paying more to fill the tank of their vehicles. So essentially, it does decrease, of course, their spending power on other goods and services. And of course, this also has a feedback loop to the rest of the economy, because if people do spend more on transport because of fuel prices being higher, there's less to be spent on consumption. And ultimately, this should once again then also decrease the demand for products, which should see some decline in product demand. So ultimately, what we think is, crude oil prices, for example, Brent crude oil now trading just around about $113 a barrel. Under a low growth scenario and where growth is weak, that is probably not sustainable. And we do believe that risk is to the downside, simply because it does take away the spending power from consumers.
Crude oil prices rallied ahead of this weekly data. What are your forecasts? Where do you see these prices going?
We believe that Brent crude will probably this quarter, in other words Q3, average between or trade between $100 and $110. So to be honest, the crude oil, as I've mentioned, and I'm talking Brent crude now at $113, we do think that it's at the high end of the range. And a couple of reasons, we did see, for example, the big drawdowns in crude oil inventories in the U.S., for example. But if you look at absolute levels of inventories, it is still well above the 5-year averages. So that, there's enough crude, there's enough product at this time. And as I've mentioned, growth, especially in Europe and Asia, is slowing, and we don't think that these prices are sustainable. So between $100 and $110, and we do believe that Brent crude for the whole year will average just below $110, and mainly because, of course, we had Brent crude at a high level the first half of the year. So essentially, we do see a weaker price second half of the year.
Walter, many thanks for your insights there. The Dukascopy TV team will be back shortly with more exclusive interviews. Goodbye for now.